So the rating agencies will be blamed for a big chunk of this crisis, and as a consequence, free markets are blamed because the perception is rating agencies are free market entities, and as a consequence, the fact that their ratings turned out to be so wrong, their ratings particularly on mortgage securities, turned out to be so wrong that look, this is a market failure. The free market has failed. Now this is ludicrous. And the reason it's ludicrous is that there is no free market in rating agencies. The rating agencies are heavily controlled, regulated, and certified by the government. So the SEC has chosen three entities, Moody's, Fitch, and S&P, to rate all securities in the U.S. Only those three. Nobody else is allowed to do it. And it doesn't count if you start your own enterprise that starts rating securities. Nobody cares because the government has said only these three rate securities in a way that counts. So they've created an oligopoly. They've created a three-company monopoly that gets its monopoly power from the government because you can't compete with them. The government won't let you. And they, in a sense, have to do what the government tells them because they have a special license from the government to do this activity. Now, what do these rating agencies do? Well, they look at securities, primarily debt securities, so bonds and all kinds of derivatives from bonds, like the collateralized debt obligations. And I'm not going to get into a whole explanation of what those are. But these were kind of bonds that were secured by mortgages, right? They got their cash flow. They paid you back based on mortgage paybacks. These agencies rated how safe these bonds or these mortgage securities are. AAA means they're incredibly safe. The likelihood that they won't pay back the money is negligent. It's almost non-existent. CCC is very risky. Likelihood that you'll never see your principal back, that they can't pay it back, is relatively high. And there are lots of different categories in between, and the different rating agencies use different letter codes in order to signal this, right? Now, why is this important? Who cares? Well, another law that government has passed over the years, a series of different laws, has basically said that there's certain participants in the marketplace, for example, pension plans, who are huge, the largest institutional investors in the market, insurance companies, mutual funds, money managers, are restricted in what securities they can buy in the market. And many of these institutions are only allowed to buy rated securities. Rated by whom? Rated by these three. Some of them, at least in some categories, are only allowed to buy AAA rated securities. Rated by whom? Rated by these three. So these three entities, chosen by the government, protected from competition by the government, have a built-in client base which is forced by the government to buy securities that these three rate. Right? So, wow, what a deal. Now, what happens if these three entities do a bad job? So, for example, in 1994, some of you might remember, Orange County, the county that I'm in right now in California, went bankrupt. That means it couldn't pay its debts. Just weeks before it went bankrupt, all of these three agencies had it rated AAA. Likelihood of bankruptcy, almost zero. They failed. What was the market penalty for failure? Like, another kind of private enterprise, right? The penalty would have been competitors would have arisen and said, look, don't trust these guys. They keep failing. Trust us. And they'd be in competition. But you can't, right? The SEC only allows these three. So nothing happened. When Enron went bankrupt, I think it was in 2001, late 2001, just weeks before Enron went bankrupt, these three rating agencies had Enron rated a AAA. Was there market backlash against them? No, because there's no market. So yes, they got the mortgage securities wrong in a big way. And who suffered? All those participants in the marketplace that are forced to buy securities rated by these agencies. So it was pension funds and money managers and insurance companies and others who use these ratings because they have to use these ratings. What's interesting is that hedge funds who don't have to use the ratings. They can buy and sell whatever they want at whatever prices they want. They didn't suffer as much during the financial crisis, certainly not from these collateralized debt obligations, these mortgage securities, because they didn't trust these ratings. They did their own research. They knew not to trust Moody, S&P, and Fitch because it's this oligopoly that doesn't really provide valuable information. And they did their own research and priced these securities based on what their research told them, and they avoided a lot of the problems that a lot of other institutions suffered from. So again, this is not a market failure. This is a failure of government regulation, and the notion now that we're going to regulate them more is ludicrous because the problem was that they were regulated to begin with. The solution is get rid of all regulations on the rating agencies, stop forcing people to use those ratings, and let there evolve a free market in research and rating of securities, and let people pick and choose whose ratings they use and whose they don't, what they want to buy and what they want to sell. The solution, like all solutions in economics, are more free markets. And the devastating consequences of regulations and controls of markets are evident almost every day in front of us. And it's time we started learning our lesson. Figure out how to get rid of all the regulatory barriers to a truly free market.